This week, we're looking at an analysis of Applied Digital, or APLD, asking if they're profitable. The material concludes that, well, no, they have a GAAP net loss, but they're building out this huge AI infrastructure.
Yeah, and the report gets that right out of the gate. It does a great job distinguishing between that $27.8 million GAAP loss and the operational health, the positive adjusted EBITDA.
Right.
That tells you this isn't just a simple story of losing money, it's strategic. But to really push this analysis to the next level, we need to dig into how it integrates the risk and the reward.
Okay, so where do we start?
Let's start with that first big point. The report clearly identifies the substantial risk from all that debt and the dilution, but it stops short of quantitatively linking that risk to APLD's, frankly, very aggressive future revenue targets.
That's a great point. The material makes a really strong case for the $500 million NOI goal, which is, the whole bull thesis.
It is.
But the $687 million in debt and the dilution risk, they're just sort of listed separately. As you know, bullet points.
Yeah, like a checklist of bad things.
Exactly. So the real challenge is connecting how that immediate financial pressure impacts the timeline for actually getting to GAAP profitability.
Precisely. The analysis tells the reader the risk is high, but it doesn't quantify the cost of that risk to the operational goals. It doesn't explain why that debt matters to the numbers they need to hit every single quarter.
So the argument needs to be less about stating risk exists and more about showing the mathematical hurdle that risk creates.
Really maximize the impact here. The suggestion is to integrate those risk metrics. I'm talking about interest expense, depreciation, directly into the discussion of the NOI goals. That way, the material can show exactly how much operational cash flow is needed just to overcome the fixed costs of this huge build-out.
You're talking about formalizing it, like maybe creating a leverage headwind section or a calculation?
Yes, exactly.
Because you could take that quarterly net loss, the $27.8 million, and put it right up against the NOI ramp-up they need from CoreWeave and the other deals.
And that provides a really clear mathematical picture of the hurdle. It frames the whole thing. The company needs to generate X million in new NOI every quarter just to cancel out the financing costs before they can even think about profit.
It stops you from just celebrating the big revenue targets in isolation.
It grounds them in reality.
And what about the cash on hand? There's another way to frame this, right?
You could, yes.
Instead of just saying dilution risk is high, the analysis could estimate the cash burn rate against their $114 million in cash.
Oh, that's interesting. So you're turning an abstract risk into a timeline.
Exactly. It illustrates the necessity of future dilution. It's not just the risk, it's an inevitability if they don't hit goal X by date Y. It puts a clock on it.
I really like that. It makes the risk factor a critical, integrated variable in the whole model. Very strong.
Okay, so that strengthens the rigor of the risk thesis. Let's move on. What's the second area we should focus on?
I think it's about the narrative of the pivot itself. We need to deepen the narrative of the strategic pivot for completeness and focus.
Right. So the analysis correctly identifies the pivot from a crypto miner host to AI cloud provider as the driver of that 84% revenue surge.
It does. It's the core of the story.
But it doesn't really quantify how successful that transformation has been.
That's the key. The growth is undeniable, but that $64.2 million revenue figure is treated as, just one big number.
A single block of money.
Yeah. And without separating the high-quality AI and HPC revenue from any lingering low-margin legacy crypto hosting revenue.
The quality of that 84% growth feels less certain.
It really does, because a skeptical reader knows their history. They'll wonder how much of that is still the old, volatile business model propping up the numbers.
So the growth rate is great, but we need to know what percentage of that is actually new economy revenue.
Precisely. The suggestion here is for the analysis report to provide a more detailed breakdown of that revenue mix. Or, if that's not possible, to focus on the rate of decline of the legacy business.
But what if those granular numbers aren't public? That's a common problem.
A very valid constraint. And if you can't get the exact figure, you build the best proxy you can with what you have.
Okay, so let's walk through that. One concrete way to do it would be to include an estimated figure for the percentage of that $64.2 million that's purely HPC and AI.
Even a conservative estimate, based on what we know about capacity allocation to CoreWeave, would be a huge anchor for the reader.
It shows you've done the work, you've done the modeling.
And it changes the story from they're growing to this specific type of growth is sustainable.
Okay, and the alternative, if you just can't get a good estimate.
Then you could detail the quarter-over-quarter trajectory of the crypto mining part of the business, show how fast that segment is shrinking.
Oh, that's clever.
It demonstrates the pivot not just by the rise of the new, but by the measurable, decisive fall of the old.
You're proving they're committed to the new direction by actively decommissioning the old one.
Exactly. It provides that narrative completeness. The reader knows this isn't some temporary peak, but a fundamental, irreversible shift in the business model.
That's a much more powerful way to frame it. Okay, that's 2. Let's talk about the third point, which is more about structure.
Yes, presentation. The best analysis can fall flat if it isn't structured for maximum impact right from the start.
So, optimizing the structure and flow by juxtaposing scale and loss right in the opening.
The structure of the report's opening, as it is now, it just minimizes the immediate impact of that high-risk, high-reward story.
It's a pacing issue. The executive summary just says, no, not profitable, and lists the $27.8 million net loss. It starts on the defensive.
And the huge counter-argument, that massive $11 billion prospective deal with CoreWeave,
Doesn't show up until section 2.
which is a significant delay. So you're emphasizing the risk without immediately providing the overwhelming justification for that risk.
You're asking the reader to absorb all of the bad news before they understand the potential reward.
Right. And to fix that, to really frame this as a true infrastructure growth story, the material needs to put the loss and the potential in direct, rapid opposition, right up front.
So the reader gets it immediately. The loss isn't a failure, it's a strategic cost.
It's the price of admission for that potential reward.
Okay, so give me a concrete example. How would you resequence that?
Well, the summary could state the GAAP net loss, but then immediately follow it with a high-impact phrase. Something like,
The company's red ink is underwriting a high-leverage infrastructure build.
including a prospective $11 billion revenue opportunity over 15 years with CoreWeave. Something like that.
That immediate juxtaposition is all the necessary context for the high-burn strategy. It reframes the loss completely.
It's no longer a negative signal you have to explain away. It's a strategic expenditure that's actually driving the narrative forward.
And it changes the whole tone. It's not a dry financial report anymore. It's a strategic analysis of a huge, high-stakes bet. It tells the reader this is a risk worth understanding.
I think it's probably the single most impactful change you could make. It sets the stage for everything that follows.